Well, welcome everyone to the BetaShares quarterly economic and investment update. Living in the 70s, is stagflation coming back? A very hot topic at the moment. We'll get on with the webinar today. Just before we do, as always, a little bit of admin to get out the way first. Please have a quick read of the slide. I will point out that past performance is not indicative of future performance, and also anything covered today is very much general in nature and does not take into account anyone's personal circumstances. The webinar today will be recorded, so if you do need to pop away for anything, you will be getting sent that after with all the relevant slides, so you can go back and cover off anything you missed or anything that you want to go over again. And please do send through those questions as we go through the webinar. Thank you to everyone that sent through questions prior to it, but if anything else comes up as we go through today, just use that widget box to type them through and we'll endeavour to cover off as many of those at the end. And as always, we provide a stack of content for our investors to go on and keep updated across BetaShares and the market. So follow us through those relevant social media outlets in terms of Twitter, LinkedIn, and Facebook. And if you go to our website, there's a heap of information on there in terms of content on funds, insights, and also sign up for Bassanese Bites, which comes out on every Monday. So about BetaShares, hopefully a lot of the people online today already know a bit about us, and thank you to those who have already taken the time to review and select any of our funds, and welcome to all those new people that have signed up for the webinar today. In terms of BetaShares, we are one of the leading ETF fund managers here in Australia, and what we look to do is provide those intelligent solutions to help Australian investors meet their financial objectives. And by that, we provide over 64 different types of funds and strategies, from low-cost ETFs to access Aussie equities at 7 basis points, smart beta strategies, all the way to sector, goals-based and thematic strategies. And with that, we manage over $22 billion. So today, we are very fortunate to have David Bassanese, the BetaShares Chief Economist, with us, which is covering off those key points around stagflation. What David does for BetaShares is develop economic insights and portfolio construction strategies. He is also our chair of our investment committee. The background in terms of David, he was a former columnist at the AFR, senior economist and interest rate strategist at Bankers Trust and Macquarie, and also, between all that, an author of a book. So if anyone is interested in learning a bit more about ETFs, there's the Australian ETF Guide, and I do suggest going on and having a read of that. It's a great resource. So in terms of the agenda today, what we're going to be covering very briefly is just a quick update on COVID. I'm sure a lot of people are across that, but really paying focus to the market outlook, economic outlook, and again, looking around what these sort of factors on the macro and microeconomic views are and how you can implement those views within your portfolio. Now, just before I pass it over to David, we are going to get a poll up, which is that up now? We'll launch that now. So if everyone can just answer the question there, do you think stagflation is coming back? Pretty simple, yes or no, and we'll see what the viewers think. Okay, I'll just give it another moment. Perfect. And there we go, no, 66% say no, and we've got 34 with yes. So we'll see if David agrees with those views as well, as he has a light little snigger. But I'll pass it over to David now. As I said, I'll be back at the end to go through some of the questions and answers. So please do type those as we run through the webinar. But over to you, David.
Thanks very much, Chris, and thanks everyone for joining us again for the last of our quarterly series on the economy. And yeah, it was interesting, that poll result. I mean, look, without giving too much away, I mean, yeah, I don't think stagflation is coming back. I'm going to spend some time today explaining exactly what is stagflation, or what it was when we did have it back in the 70s and early 80s, and how today is different to that. So obviously, you know, shows that we have quite a sophisticated, knowledgeable group with us that you know, are able to sort of read through the headlines and sort of you know, work out for themselves that maybe this is a bit of a different situation. So I will, you know, elaborate a little bit more on that as we go through the presentation today. So obviously COVID's still a big issue for markets and the economy. So I'll just touch on that as a quick update. Then we'll talk about the economic outlook, the market outlook, and some conclude with some investment themes. And I'll also introduce one particular new fund that you may have interest in the technology area when I get to that a bit later. So firstly, with the COVID situation, so here's the vaccine state of play. As you can see, we were late starters to the race. Australia, several months behind the UK and the US and Europe, but we have quickly caught up the field such that something like I think it's 70% fully vaccinated now here in Australia. In the US, or actually it's a bit more than that. In the New South Wales, it's 90%. Victoria 85%, and many of the other states now approaching 80% vaccination. In fact, in the ACT, 95% fully vaccinated. So very, very good news. And look, again, we started slowly. I'm sure you'll know the debates about the vaccines. But once we got our act together, we've certainly caught up with the pack, which is allowing us to reopen the major states of New South Wales and Victoria, which is bodes well for the outlook, as I'll touch on. If you look at the cases and death rates, so here's the situation in regions around the world. I mean, I think the UK is probably the most interesting one there in terms of the impact of the vaccines. You can see total cases in the UK, they did go through a major wave again through the middle part of this year, but the death rates this time around a lot lower than they saw, late last year, for example. So that's an example of the vaccine impact. In the US, you'd see they actually had a major, a third outbreak, if you like, the Delta outbreak midway through, well, a few months ago. That is now cresting and starting to come down. Death rates are actually still relatively high in the US. But the big difference now with the vaccines is that, those that are getting sick, going to hospital, dying, the vast majority of those are for various reasons, those that have decided not to get vaccinated. So the political will to go back into lockdown, even though with uncomfortably high death rates, is certainly dissipated due to the availability of vaccines, and that's what we'll possibly see here in Australia. Well, it's interesting though that New South Wales has reopened now for a couple of weeks, but the case count has still come down. But again, even if we do get a pickup in death rates, if it ends up the case that most of the people that are still dying, unfortunately, are those that have chosen to be unvaccinated, then there's not going to be a lot of political pressure to reimpose lockdowns as a result. So that's so just to summarise, there, vaccines have been rolling out. We have gone through another wave of COVID, the Delta wave, in recent months, through the middle part of this year, but that is now cresting, and the outlook, the US economy is starting to rebound after having a bit of a mid-year slowdown. Europe is still, dealing with cases. I mean, they have a lot freer borders, so it does move around a lot more quickly there. But again, they are, maybe somewhat more slowly than elsewhere, but gradually learning to live with COVID and reopening the economy. And as you can see, if we turn to the economic outlook, in the main, we are still enjoying a pretty good growth rebound. So these are GDP, prior to COVID, then the very sharp downturn that we had during the first couple of quarters of 2020, and economic growth, as you can see there. So that's GDP has bounced back, particularly in countries such as Australia and the United States. Japan and Europe they did have an initial fast rebound, but then when the Delta wave struck, that sort of disrupted growth late last year and into this year. But in the main, I mean, the story is that global growth recovery remains on track. They're looking at some IMF forecasts, GDP down 3% in 2020, expected to bounce back by about 6% in 2021, and then actually hold up at around 5% in 22. So pretty solid growth rebound globally expected. In the US, those numbers are negative 3.5% in 2020, 7% growth in 21, so i.e. this year, and then about 5%, or 4.9 strictly speaking, but let's round it to 5% in 22. In Australia, those numbers are for this year 5.3% growth, and then 3% growth next year. So we didn't have as deep a downturn, so we're not having as rapid a recovery, but nonetheless, it's still a pretty good recovery. And what does that mean for markets? This is a chart of forward earnings. So this is the underlying earnings for the S&P 500 in orange, and the bars there are the revisions ratio. So these are the net change in analysts' expectations for earnings. So when that's in a positive territory, it means analysts are generally upgrading their outlook for earnings. And as you can see, we're going through a very strong earnings upgrade cycle. The US just went through the third quarter earnings season, and despite all the talk of cost pressures, pricing pressures, difficulty of finding staff, businesses still punched out very strong earnings numbers, and there was an upgrade to the earnings outlook. So, one way to think about the inflation pickup, which I'll talk about in a minute, is that yes, the businesses have faced cost pressures, but they've been able to pass those on to prices at the moment, which has been great for profits, not so great for headline consumer price inflation, but I think that's the situation at the moment. And as I would say, when you're thinking about the outlook for the next year, the real economy, the earnings outlook is actually pretty solid. So that's the least uncertain aspect, I think, of the market outlook, is the recovery in economic growth and the ongoing recovery in corporate earnings. The bigger question is, are we going to get a lot of inflation with that? Will that mean that interest rates have to go up? And will that in turn put downward pressure on still reasonably high equity valuations? So earnings may be good, but if interest rates go up quickly and pull down equity valuations, the market may not enjoy the sort of growth that it's certainly had since early last year. So that is the key question. And just on that, just go to the next slide here, and you can see here is the US inflation. I'm just going to move something around here over this side. That's good, no worries. Yeah, so, and as you can see, look, we've had this is the core PCE, that is the private consumption expenditure deflator. So it's a little bit different to the CPI. And the reason being is that it actually, the weights of different items are more flexible. So if you get a big increase in a certain item within the consumer basket, and people reduce their demand for it, the weight of that in the calculations tends to go down. So I guess it's a better measure of inflation than, say, the CPI, where the weights don't vary as frequently there. And so generally speaking, CPI inflation in the US tends to run a bit stronger than the private consumption expenditure measure. So these are the ones that the Federal Reserve target, the US central bank. So that's why I've focused on them here in this chart. So a couple of points to note is you can see that the core PCE, the orange line, has now pushed up from, it was running just under 2% for several, many years. Basically for a decade since the GFC, core PCE inflation was running at sub 2%, and now that's spiked up to 3.5%. And core is basically stripping out the direct effect of food and energy prices or petrol prices. And so if you look at the headline number, which includes those, that's even higher, running at just over 4%. So hence all the headlines and concern about the US inflation story. And as you may know, in Australia, only a couple of weeks ago, we got a CPI number here, which was a bit higher than expected. Still not that bad, but little bit higher than expected, which is, means that the RBA's maybe, more likely to raise rates, say in 2023 than in 2024, but it's still looking, very unlikely in 2022. But the broader picture here is we are seeing some inflation pressures, some pricing pressures come through in a range of countries as they rebound from COVID. And some of the drivers there, if you look at some quirky things like used car, the bottom line there is the index for different prices that are part of the inflation calculations in the US. And so the orange line there, used car prices. I mean, who would have thought? I mean, used car prices would suddenly go through the roof, but they've a very strong uptick through last year. And that's actually a reasonably large weight in the inflation calculation, particularly when you get these very sharp increases. And, really the story here is there's been a shortage of new cars. because there's been a shortage of computer chips, because there's been an increase in demand for consumer electronics around the world, be it laptops, mobile phones. They all tend to use the similar computer chips, and so there's been this rush for demand of computer chips that have led to shortages, and as a result, people have had to buy used cars, or the demand has fallen back on that, and so you've had this increase. So it's a kind of weird outcome of COVID and computer chip shortages, in turn leading to an increase in used car prices, but that's the way it's worked. Other areas, things like airline rates, which collapsed in the early part of COVID, as you would expect, have then since rebounded strongly, and then I think hotel rates also. So you're seeing in areas of the services sector where prices initially were slashed due to the shutdowns, as the economies reopen, businesses have put those prices back up again. So there's a couple of things going on. One, some prices are just clearly going up a lot because of shortages, in the case of cars, and others, they're putting their prices back up to where they were prior to COVID. But the combination of all of these things is leading to this uptick in inflation. Now, what's happening there? There we go. Sorry about that. And and it's led to this increase in talk of stagflation. I mean, so this is a Google search of the number of times stagflation is looked for in searches. You can see there's been a funnily enough, the last time it was this high was back in the GFC. So bad times tend to lead people to speculate about all manner of economic events, and stagflation is this big bad bogey that we did have in the 70s, and obviously people are concerned about it. So I'll talk a little bit about what stagflation is and why that really what we're seeing at the moment isn't stagflation. So this is stagflation in the this is what stagflation looks like. So what I've got there is a chart of the US unemployment rate in blue, and the US, those inflation measures that I showed you earlier, both the headline and the underlying measures in green and orange. And if you look at the early 70s, and so there was a time where we had a massive increase in oil prices, which was a negative shock to the US economy. So costs went up for businesses, and they had to slow and hurt economic activity. And so you had a combination of inflation going up because of oil prices and unemployment going up. So that is stagflation, when you get rising unemployment and rising inflation at the same time. And then we had another rerun of that in the early 1980s. And so basically when stagflation arises, and I'll just try to explain it here, and it's in that upper right, upper left section there, when you get what we economists call a negative supply shock. So for example, if the price of an important input into production, which in the 1970s was oil, goes up in a big way, then that has a negative impact on businesses. They have to basically either pass that on into prices, which hurts real consumer spending, or they take a massive cut in profits, which means that they probably need to cut back production. So, but the combination of all of those means that activity declines and inflation goes up. Now, you can get rising prices with unemployment falling, and that's the boom where you get a positive demand shock, and that's the other sort of section there. So these are sort of various states of the economy that you can talk about. It all really is driven by what is the predominant shock to the economy. Is it a demand shock? Is it a supply shock? And is it positive or negative? And so when we're in an environment where economic growth is strong and inflation tends to be rising, it's a positive demand shock. You've got demand, more demand chasing goods, and that's putting up pressure on prices, and activity's growing and unemployment's falling. So I actually think we're in a boom period at the moment, like with the V-shaped recovery from COVID. And so what we're seeing at the moment is more of a boom. And one of the reasons for, growth being maybe stronger than, quite strong, and inflation being quite strong, is in the case of the US in particular, the US stimulus, the Biden stimulus, as I call it, in early 21, it was a $1.9 trillion stimulus, of which it included a $1,400 checks mailed out to virtually every person, every adult in the country earning less than $80,000 a year. So that was a big increase in demand. And you can see the impact here. The first chart there is the goods demand relative to services. So relative to the underlying trend prior to COVID, we had a collapse in goods demand initially, but then a massive increase in goods demand in the US, even relative to services. And it's been that increase in demand for goods that has led to shortages. So it's, when people say supply chain disruption, it's not that we've suddenly lost our ability to produce things. It's just the supply chains haven't been able to keep up with the increase in demand. And another example of that, if you look at the second slide there, is the activity going through Los Angeles ports. And you can see that in 2021, there's actually more activity going on than there was in 2019, i.e. prior to COVID. So people talk about log jams in ports and whatnot. It's not that, you know, they're suddenly not able to process all the goods, all the imported goods. They just can't process as much as has been demanded, and hence that's why there's been these shortages. Add to that various other issues, as I'll talk about. There have been labour supply shortages, but in the main, you know, they've been trying to get more truck drivers, for example, to ship freight around the country, but you know, they've still got a lot of truck drivers. They just don't have as many more as they need. So that's been so again, going back to this issue, it's not stagflation, it's actually an economic boom in effect. And in fact, you can see it here where, so prices have gone up. So if you just look at 21 there, you've got that sort of slide there. Prices have been rising through 21, and unemployment in the US has still been coming down. So so again, just to distinguish what we are seeing today with a stagflationary environment. And as a result, I mean, if growth did slow, I don't think we would see growth slowing and inflation staying high, which is the worst case scenario for markets. You know, people say, oh, you know, so talk of stagflation next year means, yes, growth will slow, unemployment will rise, but inflation will somehow stay high. I think if demand does slow, inflation will slow as well. So then we go back, if you go back to that earlier slide, we go into this more, I wouldn't say recessionary period, but that would be, you know, weaker growth would be associated with lower inflation. But I actually think, you know, one scenario for next year is we move from this boom to a Goldilocks period where growth does slow, but it still remains pretty good. And inflation does start to moderate as well. And if you look at some of the supply chain bottlenecks going on around the country, and this is in the US in particular, you can see the Baltic Dry Index is a measure of container costs, you know, the cost of shipping freight around the world. Inventory numbers, manufacturers' inventories have plummeted. So basically what you've had an increase in shipping costs, because of the increase in demand for freight. An initial increase in demand for goods led to a slump in inventories. So basically, you know, manufacturers ran out of inventories. So you've had a big decline in the inventories index. You've had an increase in orders backlog and an increase in supply delivery time. So these are examples of, you know, these bottlenecks that have emerged. But there are tentative signs of these things turning around. So if you can see, the inventories are starting to recover somewhat. There's been the container prices have come off a little bit. They're still high, but these are the things I'll be watching over the next few months to see if these bottlenecks ease. And I think they will ease as goods demand does start to taper off, and, you know, supply chains manage to catch up with the increase in demand. And the other thing is, you know, one thing that obviously has also been going on is that oil prices have gone up from, you know, very low levels last year to, you know, $80 a ton, $80 a barrel, from you know, $10, $20 last year with the recovery in demand. But so in a way, it is similar to what we saw in the 70s, where oil prices did go up. But you know, this chart just shows you that the big difference between now and back then is oil is a less important component of GDP. So it doesn't have quite the negative impact on growth as it used to have, because the oil intensity of economic activity has tended to decline since the 70s and early 80s. The other point to note is one of the issues in the 1970s when when we got a big increase in oil prices and a big increase in consumer prices, workers were able to go out and then demand higher wages, and that led to a wage price sort of spiral. So wages went up, then businesses passed on those wage increases into prices, and that's really what inflation is. Inflation is a spiral type of thing where you get an embedded round robin effect of wage increases and price increases, and it's sustained at a high level. And that's what we saw in the 70s. These days, and one of the reasons for that was that unionisation. Got nothing against unions, but it gave them a strong bargaining power, particularly in areas like manufacturing. Unionisation rates have come down, so workers don't have quite the bargaining power they used to have. And also with globalisation, businesses find it less easy to simply pass on prices on a sustained basis, given we're in a global market. So I don't think the impact of oil prices, for example, is less on the economy, but the ability of both workers and businesses to then embed that into a wage price spiral is a lot less than what we saw in the 70s. So really, the best way to think about what we're seeing is it's a increase in demand for physical goods, a surge higher in goods coming out of COVID, which supply chains have been unable to keep up with. And it's sort of like it's a log jam which we're trying to work our way through, rather than the start of a cycle. And so that's why I think inflation next year will start to dissipate as supply catches up and that surge in demand starts to moderate. One issue to think about in the US is the wage pressures there's a few things going on. The other thing going on in the US is the fact that there are labour shortages, even with the unemployment rate still around 5%. Wages growth has picked up. I've got various measures of wages there. The Atlanta Wage Tracker is a measure that looks at wages allowing for compositional shifts in the workforce. So, at the moment, a lot of the job losses, a lot of the remaining job losses in the US have been in areas of hospitality, where workers have been on below average wages. So those job losses have actually, artificially boosted, if you like, average hourly earnings measures. But these other measures like the wage cost index, the wage tracker, but particularly that Atlanta Wage Tracker measure, that allows for those compositional shifts. So it measures wages for given occupations, and that's clearly picked up as well. But that is reflecting labour shortages due to the fact that, if you see on the second slide there, the labour force participation rate hasn't quite recovered to where it was prior to COVID. And this, to me, is the biggest concern for markets, this labour force participation rate in the US. Will the millions of workers who left the labour force during COVID come back? Because if they don't start actively seeking employment, labour shortages will persist, wages growth will remain firm, and the Fed will have to conclude that they've reached, their capacity constraints, and the economy does have to slow down, which may need interest rate increases as early as next year. So that to me, it's not, the fact that headline inflation is high due to these bottlenecks, if you like, that's not the main game. The main game is is the US labour market situation, whether or not labour force, the participation rate can pick up. Now, I think it will pick up. I think there's a lot of people that have been sidelined, due to fear of COVID, having to stay home and to look after relatives that have been sick with COVID, or kids that haven't been able to go to school. There's been the temporary unemployment benefit insurance that's been provided, which has created a disincentive effect in many states. All of these things are slowly being resolved, and I would be surprised if this participation rate didn't start to get back to where it was prior to COVID over the next 6 months to a year, which should take the pressure off wages growth. But again, that is the issue that that is the bearish case for the markets, is that wages growth picks up, the Fed has to raise rates, and you get a bigger correction in the markets. In terms of Australia, look, the wages growth is a much more benign. If you look at the wage cost index, it's running at just under 2%. Unemployment has come in, and we did get a tick up in the CPI there, the trimmed mean CPI. It's now running at 2.1%. So, but look, the bottom line it's really quite simple here in Australia. The RBA is going to raise rates when it sees that wage cost index get up to around 3 to 3.5%. Now, if that happens next year, they'll raise rates. If it happens in 23, they'll raise rates. If it happens in 24, they'll raise rates. At the moment, the RBA says it won't happen until 2024. So that's why they're still saying they think they won't need to raise rates until 2024. There's a chance it could be 23, but they think it's very unlikely it'll be in 2022. They basically don't see wages accelerating that fast to bring forward those rate rises. And I would agree with them. But my base case is it will probably happen in 23. So I've got good growth in the economy, unemployment dropping down to say 4% by late next year, and wages growth picking up to around 3%. Which should be, put the conditions in place for the RBA to maybe raise rates in early 23, along with the US Federal Reserve. And this just shows the challenges of trying to get wages growth up. You can see this is called the Phillips curve. So it's a relationship between unemployment and wages growth. And you can see that historically, for given levels of unemployment, we've got lower and lower rates of wages growth over time. So hence the challenge of trying to get wages up. The good news is that it means you need a very low unemployment rate to get wages growth up, something of the order of say 4%, possibly even lower, again, which is actually good news for the economy. It means we can let the economy grow strongly if it's possible, without generating much wage and price pressure, and hence, ultimately that's why the RBA is keeping rates low at the moment. In terms of the market outlook, as I said, I actually think we're in a boom condition at the moment, for the reasons I outlined, and I think what we may evolve to next year is more of a Goldilocks sort of situation where, inflation in the US does start to moderate, but growth remains good. So interest rates can stay on hold, central banks not raising rates, and equity markets can continue to grind higher on the back of that very good corporate earnings result. And this just shows you the challenges of that. The PE rate, I'll just highlight the PE ratio in the US there at 20 times earnings. The faster interest rates rebound, the more quickly that will decline. And so, you can see at the moment, US interest rates on the bottom slide there, about 1.5%. Their average since 2013 has been around about 2. So if everything went back to the average since 2013, which has been where the period where interest rates have been stable, that PE ratio would need to come back to about 17.5. I've got it going to about 18, not quite to 17, but 18 on a 1-year view, so late next year, which is 10% off, but earnings growth rising by about 15%. So net, you're still getting 5% growth in the overall market on a 1-year view, plus dividends, which again, it's not certainly nowhere near what we've had, but it's still not. It doesn't mean the market needs to crash. But you may get a pullback at some point. But on a 1-year view, it's still consistent with equities moving higher. Look, in the interest of time, I might skip through some of these slides and get straight to the investment themes, because I do want to just in the few minutes remaining, focus on some of the what's going on within global equities, and these are really just summarising some of the themes. And really, since the GFC, we've had US outperforming, we've had growth outperforming value, which has been the technology sector. So these are relative performances of different investment exposures relative to the global equity market. So, or in the case of growth versus value, it's things like technology versus value areas of the market, like energy and financials. So it's been a tech growth-driven world, a US-driven world, and COVID, really if anything, accelerated that trend favouring technology and the US market. And you can see, unfortunately, there Australia has tended to continue to generally underperform. So our market's been going up; it's been doing okay, but just hasn't been doing as well as global markets. And that is and I think at the moment, and I think, look, as the dust settles and as the inflation fears moderate, I would suggest that this growth thematic will continue to prevail. When in that period where the central banks do start to raise rates, is an area where financials may do well, global banks. But otherwise, I think if inflation does moderate to an extent, it's still going to favour those growth areas of the market. And if you just look at it, that's the technology sector up the top there, and the PE premium to global markets. So look, it's trading at it always trades at a premium to global markets, but not as much. It's not certainly nowhere near where it was during the dot-com bubble. Banks look cheap, but they've looked cheap for a while. Energy, despite its long-term trend of underperformance, it's actually not that cheap on a relative PE basis, and that's because the earnings ultimately have still tended to underperform over this period. So that's been the snapshot of some of the major thematics going on. Aussie market, as I mentioned, has tended to underperform. You can just highlight the top right corner there. If you look at relative returns and relative earnings, it's really an earnings story. We had a commodity boom a decade ago, and we've been in a tech boom ever since. And I still think we're in a tech boom rather than a commodity boom, and that's going to continue to favour global markets over the Australian market. I'll just conclude on some of these, just on the Aussie dollar, a quick comment here. I'm not a bull on the Aussie, haven't been for a while. It's still, it was threatening to hit 80 cents earlier this year. I said it was going to drop back down to 73, which it did. And I still think it's going to likely stay in this low 70-cent range on the back of iron ore prices continuing to remain weak. The US dollar probably firming up, and the US economy is looking quite strong. And the combination, and the Fed, may be raising rates somewhat earlier than the Fed, the RBA, by 2023. But the main story here is, I think, China is tightening, is reducing its steel reliance on steel production. Iron ore prices still have a ways to go to get back to more normal levels, and that will probably drag down the Aussie, or at least keep it in the low 70-cent range rather than pushing up a lot higher. So just to go through some of those various growth exposures. So look, if I took a 3-year view, let's say, I would still say that growth and technology is going to outperform value areas of the market. And so we do have a suite of those sort of funds like cybersecurity, hack, global robotics, RBTZ. Asia, which I've touched on in the past, so Asia technology. I mean, if there's one area of technology that it seems to offer good value at the moment, there would be the Asia technology area, because it has had quite a notable pullback. I did a blog on this a few months ago. Due to the policy changes in China, there's been some regulatory risk around those companies, but their earnings outlook is still pretty good. And obviously NDQ being the NASDAQ itself, those FANG stocks, Google, Amazon, Facebook. One I wanted to highlight was CRYP, which we just launched, was the crypto. It's a crypto, well, it's not cryptocurrency. It's not it doesn't track the Bitcoin price, for example, but what it does do is track a portfolio of companies, leading companies in the crypto ecosystem, if you like. So cryptocurrency exchanges, crypto mining companies, companies that provide equipment to mining companies. And so these are areas, irrespective of whether Bitcoin goes up or down or various other cryptocurrencies, if overall interest and activity in cryptocurrencies remains high, then these companies are likely to continue to do well. So importantly, it's an equity exposure. It's not a Bitcoin exposure, so it's like another thematic, global equity thematic, if you like. So that's just been recently introduced, and if you've read the papers, you'll see it's been the most popular launch of an ETF in Australia in history. Basically, I think we're 100 million already. Yeah, so 100 million within a week. We've already got 100 million into that fund. Some inflation. Look, if you do think inflation, I'll just highlight again. I'm not really into that, but I mean, if you are worried about inflation and you think oil prices are going to go onwards and upwards, then fuel, FUEL, would be an interesting exposure. Global energy companies. If you're bullish on resources, QRE, global Australian resource companies. Food is global food producing, and gold, QAU. But again, I actually think the inflation story will tend to moderate through next year. But I just highlight that, we do have over 60 funds and different exposures depending on your view of the market. And here are some of these value exposures as well. Now, the one I'd highlight there is BNKS. So if you're looking for something that does well when bond yields rise, BNKS is probably your ticket there, global financials. And that's actually had a very good run. I mean, energy and banks have had a very good run over the past year. So value has done okay with the rebound in oil prices and interest rates. And they may, in this period of concern with oil prices, they may continue to do okay. But at the moment, I think bond yields are probably, moving higher gradually over the next year or so. So BNKS may be an interesting type of exposure. I'm not as convinced about oil continuing to go ever higher. And energy companies do have, there is that transition to alternative energy going on. And fuel does give you exposure to those more traditional energy companies. So I'm not so convinced about that one. But I do like BNKS as a play on rising bond yields as we get closer to Fed tightening. Europe and Japan are other exposures, which again, I tend to still like the US market, to be honest, but I just highlight those exposures. They do look relatively cheap to the US, but their growth outlook, I think, is still ultimately not as good as it is in the United States. That's pretty much it from me. Thank you very much for your time, and hopefully we've got some time for questions.
Yeah, certainly, and thank you so much, David, for covering that. I'm sure our listeners got a lot of insightful information out of that too. Look, in terms of questions, again, thank you everyone for sending those through. There's a stack of questions here. Look, just to start off, David, on inflation, in terms of inflation figures, is that something that our investors should be paying attention to in terms of those figures, or actually how central banks are responding to these?
Yeah, very good. Look, ultimately, what's going to drive markets is going to be interest rates. So if you think about equity valuations, as I showed you in that chart earlier, the US market is trading at a P/E ratio of 20, which is okay provided bond yields stay low. But if bond yields go up, then there's greater downward pressure on that P valuation. So it really depends on what the bond market reacts to. So if the bond market, for example, if inflation went up and central banks ignored it, as the Fed is actually doing at the moment. So the US Federal Reserve is saying, yes, inflation's high, but we think it's transient. We think it's not going to last. It's going to go back down again next year. We're more focused on the labor market, as I showed you before. If the bond market doesn't agree with the Fed and starts to price in higher inflation for longer, then bond yields will go up because they've got to price in that inflation expectation. And that then, even though the Fed ignores it, will hurt the equity market. So that's the, I guess, the tug of war. So if bond yields basically don't believe the Fed ultimately basically has to, for its credibility and to contain the bond market, probably be seen to be doing something and then react to the bond market. So that's the tug of war at the moment. So if you look at the central bank, the markets at the moment are pricing in the Fed raising interest rates next year. The market thinks inflation is going to stay high enough for long enough that the Fed will need to raise rates next year. At the moment, the Fed is saying, no, we don't think that's the case. And I think the Fed is ultimately going to be proven right on that front. But that's the issue at the moment. So you do need to look at it, but ultimately what you need to look at is the bond market, because that's really the adjudicator of where valuations in the equity market will go.
Fantastic. And look, just another point to that, where there was a few questions around, should our investors be looking at the growth of money supply or the velocity in which that money is being pumped into these economies? Is that sort of a determinant in terms of inflation as well?
Look, I'm not really a monitor. We used to think that quantitative easing, where the central banks were buying bonds and printing money, would necessarily cause inflation. It's not clear that is the case. I mean, what's caused inflation in the US is more than monetary policy. It's been the fiscal policy around the world, but particularly in the US, has been supercharged. I mean, we basically spent heaps of money to get our economies rebounding from COVID, whereas the economies were rebounding of their own. I mean, anyone who listened to some of these webinars earlier this year, I said the Biden stimulus was completely unnecessary and was going to be petrol on the flames, and that's basically what happened. Were it not for Delta, which actually slowed the US economy a little bit mid-year, I mean, potentially inflation and growth would have been even higher. So Delta, in a way, helped slow the US economy a bit in the middle of the year to offset some of that stimulus from fiscal policy. So I don't really think the money, the money supply is the main driver here. It's the stimulus that's come from particularly in the case of the US from the Biden stimulus earlier this year.
Okay, and look, there's another question around inflation in terms of, with ever increasing productivity enhancements, cost reducing, technology improvements, are we ever going to have long-term sustained inflation?
Yeah, very good question. And this is, again, one of the Goldilocks scenarios for next year, that even let's imagine that the US labour force participation rate doesn't come back. As I said, maybe people have permanently, and one point I'll make on that, the US is not Sweden. You know, the US is not a welfare state. So if you can retire and you've got a nest egg to live off, you know, good luck to you. But I mean, if you're, you know, young or whatever, and you know, people have got to work. So I mean, I'd be staggered if, you know, people permanently leave the labour force, because, you know, how are they going to survive? But on that point, if worker shortages persist, you know, what we'll see is that, and the other thing going on is onshoring. So, you know, a lot of manufacturing is now, because of the vulnerabilities that have been exposed in supply chains, looking to produce more of their, you know, production closer to home, closer to their home market. But this may well encourage more investment in robotics, you know, more, you know, productivity enhancing innovation, essentially. So what we may find is that rather than create inflation, labour shortages cause a pickup in productivity growth. And so wages growth may remain actually, you know, firm, but it doesn't flow through to prices because of the strong productivity growth that businesses are being able to achieve. And so that, just to think about investment options coming out of that, robotics, RBTZ is our global robotics ETF. Labour shortages around the world is an absolute boon for the global robotics industry. So that's you know, one investment outcome of that. But yeah, I think ultimately I can't see sustained inflation, because we live in a globalized world where technology disruption is, you know, only accelerating. You know, so I think it is very hard to see it being sustained.
Excellent, thanks for that. And look, say we don't go into that sort of positive supply shock Goldilocks view next year, or market next year, and we move to that upper left quadrant that you showed earlier in terms of stagflation.
Yep.
How do economies move out of that and move into, again, something like a boom or Goldilocks potentially?
Yeah, look, I mean, how did we get out of it back in the late 80s? I mean, anyone with, you know, who's followed markets is old enough to remember Paul Volcker, the Fed chairman. So basically what happened, a very snapshot, stagflation globally led to this increase in inflation expectations. So everyone was basically expecting inflation to be about 5 to 7% every year, because that's what it's been every year. And so if that's what you expect, you know, workers demand 5% wage increases, and businesses say, yep, fine, and I'll just increase my prices by 5% as well. And that's where you get the cycle, you know, the wage price spiral. Now, how did that end? Paul Volcker, the Fed chairman, jacked up interest rates to like 18%, caused a massive recession, and it basically crushed pricing power. So that was the catalyst, you know, a major recession to crush inflation expectations. On top of which, there's an argument, you know, that was also the time when globalization really kicked in, where companies basically began to outsource a lot of their production to, you know, lower cost emerging markets, such as, you know, Korea, China, of course, and also, I mean, containerization, this is a whole fascinating, why did globalization begin? It began because of containerization. The invention of containers allowed people to ship things across the world a lot more cheaply than they were able to do before. So it wasn't just because China suddenly became this great place to produce. If it cost a real bucket load just to basically send stuff from China to the US, then China wouldn't be a viable source of production. But when it becomes a lot cheaper to ship stuff from China to the US due to the invention of containers, then it becomes in play. And so that's what we saw. So it was that combination of a big recession, crushing inflation expectations in the early 80s, then the progressive outsourcing of manufacturing, and then obviously, tech disruption that's been ongoing for the past 20 years. That's how we eventually get out of it. But there's no easy answer. Once you're in stagflation, you basically need a very deep recession to drive inflation expectations back down again.
Thanks for that, David. Look, there's a number of questions coming in around the property market and views around that. And I know you referenced earlier in terms of the RBA's decision around potentially increasing interest rates is really going to be around the unemployment figure. But also, is there fear, I guess, of increasing interest rates also playing a part in terms of how over leveraged some of these homeowners are as well? Does that influence the RBA's decision?
Look, I think the RBA has basically outsourced the problem of the housing market to APRA and the macroprudential controls. And so you've seen, obviously, that they've tightened the requirements. So they basically have insisted that banks not lend to anyone that can't demonstrate an ability to pay a mortgage with interest rates 3 percentage points higher than what they are at the moment. So this is basically enforcing this interest rate buffer requirement. Now, if the housing market remains red hot, APRA will do more. They might tell banks, you know what, you've got to slow demand for lending back to, say, low single digit numbers, or you've got to increase the interest rate payable for investor lending. So there's any number of things that they can do without raising interest rates to slow the property market, which has basically meant the RBA's had free rein to keep interest rates low. And I think that's going to be the outlook going forward. So the RBA isn't going to raise rates because of a hot property market. But by the same token, it is aware, obviously, when it does come time to raise interest rates, the fact that, household debt is high, we're all very highly leveraged into property. What it means is it won't take much of an interest rate increase to probably slow things down. And so, maybe 1% would be all they need to. So the problem is, the longer interest rates stay low, and the longer people basically, borrow based on that expectation, the harder it is for them to raise interest rates thereafter. So I think that's the best way to think about it is ultimately it's going to constrain how far the RBA needs to raise rates to slow the economy.
Okay, perfect. And look, I know that you highlighted a couple of slides there in terms of way of positioning portfolios. Again, with BetaShares, we do give our investors the ability to really sort of tailor the portfolio to their views. On that stagflation environment, and you did highlight gold as QAU or MNRS as another exposure that can give you exposure to that. How does that actually benefit in a stagflation, if we can unpack that a little bit more?
Yeah, so gold, go back to the 70s. In a high inflation environment where equities do badly and bonds do, so basically, that's the other problem for us as investors. A stagflationary environment is bad because it means interest rates rise and corporate earnings fall. So it's bad for bonds and it's bad for equities. And so you're basically left with going into cash or going into real commodities that typically benefit a high inflation environment, one of which being gold. So you may find that investors that don't want to own bonds, don't want to hold equities, decide to park their money in gold, and so that can push up gold prices. So gold is one of those areas that would probably most benefit in a stagflationary environment. Look, the only counter to that, of course, is that if the economic conditions are weak enough, people may, not have the, willingness to buy gold. They may be maybe selling gold to pay off their other debts and whatnot. So, but that's one. And then of MNRS is global gold miners. So if gold does do well, you can buy the gold bullion through QAU. So that's exposure to gold bullion sitting in a London bank vault. So quite easy way to invest in gold. Or you can invest in global gold miners, which obviously tend to do well when gold prices go up. So that two, very easy, convenient ways to get gold exposure. Should you be interested in that? And as a general point, as I said, I've got a view about the inflation outlook, which is not super bullish for gold, but I could be wrong. And I'm not often wrong, but I could be wrong. No, I'm kidding. But the other point about gold is just as a source of diversification. It's there, that it is something that will do well when other asset classes don't do so well, particularly in a high inflation environment. So, we speak to many people that use it as a source of diversification to have a small component of their portfolio in it.
Excellent. And look, I think we've got time for one more, and it's, I guess, quite topical given COP22 was only just last week, and you do on that slide there have QRE, which is our resource sector exposure. How do you think COP22 and the general, I guess, move to more ESG focused economies is going to affect the resource sector here in Australia?
Look, not well, obviously. I mean, I think and we're probably dragging our feet on climate, dealing with climate change. So we should be, we are major energy exporters in Australia, major resource company, resource economy, and the world is transitioning from old energy to new energy, and we're going to be left behind if we don't make that transition. So I know companies like Fortescue are investing in alternative energy. It's a very and BHP are trying, but obviously their major legacy activities and assets are in traditional resources. But look, there's this general trend to newer, cleaner energy is going to, I think, broadly speaking, make it even less likely we're going to have a traditional commodity bull market. And as a result, the resources sector is probably going to be a drag on our market, and as a result, our market tending to underperform global markets. But again, we do have Earth. If you're worried about QRE, we do have ERTH, if you're not familiar with it, is our global climate change ETF. And basically, it's exposure to a bunch of activities designed to reduce our carbon. It's a decarbonisation theme, effectively. So it includes exposure to renewable energy companies, companies looking to develop alternative food, for example, that doesn't rely on, traditional farming, clear, more efficient energy use in terms of building construction. So that is, an ETF for that. Again, another great thematic, I think, in terms of going forward. What is a major thematic is the world trying to decarbonize. So having exposure to those companies. So again, if I had to choose between QRE or Earth on a medium-term view here, I'd have to go with Earth.
Excellent. Well, thank you very much, David. And look, just in conscious of time, we're coming up to just about upon an hour right now, so we'll probably just wrap it up there. Just remember, things to consider: investment risk, no guarantees in terms of future outcomes are uncertain. General information, again, just reiterating that any information today is not personal advice and very much general in nature. And again, if you are looking for that more detailed advice, we do implore you to go seek professional advice around that and jump on the website to get any PDS additional information on any of the funds. Thank you all for joining us here on the webinar today. On that question slide, we do have an up-and-coming BetaShares Crypto Innovators ETF, which goes under that ticker code of CRYP. If you want to learn more about that and that crypto economy and then the potential, I guess, benefits to that, please do register your interest there. But have a lovely Thursday. Thank you.